Welcome to Get Started Investing, the podcast where we cover everything that you need to know to kick off and grow your investing journey. Whether you're brand new to investing or you don't know where to start, or you're an investor already and are looking to learn more, welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode because we are covering something that everyone dreams of. Whether you love your job or not, I think the idea of replacing your salary with passive income is very attractive. Yeah. And in this episode, we're going to go step by step on how you can do it.
That's it. We're going to look at the three main ways you can replace your salary with passive income, why we think investing in the stock market is the right way to do it, and then, as you said, Ren, some clear steps on actually how to take action and make it happen.
Now, one piece of housekeeping before we get into it. The podcast Comedian v Economist is back and it is available wherever you listen to podcasts. It is one of our favorite podcasts we produce here at Equity Mates. It's a lot of fun and you will learn a lot. So go and check that out if you're looking for your next listen.
Nice. Well, passive income, what is it? It is income that you can generate without having to lift a finger.
Yeah, exactly. You don't have to work for it. You don't have to think for it. You don't have to do anything for it.
You can go to sleep and it'll still pump out income. What does Warren say?
Find a way to make money when you sleep.
Yes.
Or you'll work until you die.
There we go. That is the perfect way to start this. And for us, there are three main ways that you can generate passive income.
And this isn't new news for anyone, but I think the most common way people think about generating passive income is having a business that spits off income. You know, whatever it is, something that they've built and then they no longer need to work on, but they get paid.
I went down that route with my drop shipping, if everyone remembers the $100 challenge from last year.
Not your finest entrepreneurial moment, we'll leave that there.
Anyway, shout out to the one person who bought Sunnies. Thank you. Keeps my dream alive.
The second really common way you hear about generating passive income is property ownership and getting paid rental income. And then the third way, and the way that we're really going to focus on today, and we'll explain why, is investment assets, be it stocks or bonds, those assets that will pay a dividend or a yield for you doing nothing.
Yes, yeah. So property is probably the most commonly perceived way, but for us, there are a lot of reasons why we like stocks over property. Firstly, low cost to get started. And we'll go through that in a bit, but diversification, liquidity, in other words, the ease in which you can buy and sell, and the effort required to maintain a portfolio of stocks versus a portfolio of property, it's a lot less.
Yeah, but what we're going to focus on, the main reason, the most important reason, are the cold, hard facts. The numbers don't lie.
No.
So you'll often hear about rental yield, which is measured as a percentage that what you get paid an annual rental income versus how much you paid for the property. And it's similar calculation to calculating dividend yield, where the income you get paid from a stock versus what the stock price is, or bond yield, the bond price versus how much you get paid. So the calculation is all the same, and it's the critical calculation when we're thinking about investing our way to passive income. When we're talking about rental yield, you'll often see numbers like 3 or 4%, maybe in Sydney or Melbourne, it might be 1 or 2% rental yield, but that is gross rental yield. That doesn't include all the costs that go in to owning property. And when we talk about net rental yield, so the rental income you get less your costs, it's a very different story.
Yeah, I mean, to put some clear numbers to it, and it becomes immediate very quickly. You have a home loan of $800,000 or whatever, and you're told the gross rental yield that you can get on that is 4%. Sounds pretty good, but then immediately you're paying 6% mortgage.
Yeah.
So straight out of the gates, you're 2% down as the money coming in versus the money going out. That then doesn't include rates, fees for paying real estate agent, maintenance,
yep.
strata,
property tax.
Yeah. So you can already see how quickly that 4% gross yield gets sucked away. And that's why we get into this position here of negative gearing.
Yeah. So according to the Australian Tax Office, around 30% of Australians own an investment property. 40% of those are neutral or positively geared, which means they're making more money from rental income than they're spending on costs, including mortgage costs. which means 60% of investment properties are negatively geared. So if you're thinking about investing your way to passive income, the important number for you is net yield after cost, because that's your passive income. And the majority of investment properties are not earning any income after cost. They're negatively geared.
Yeah.
So like the obvious conclusion from that is if you want to invest your way to passive income through property, you need to completely clear the mortgage, basically.
Yeah, it is possible. There are, from what I've learned on Equity Mates Investing with Sam Gordon, our investing property expert, there are definitely cash positive properties out there.
Yeah.
But you're sacrificing the capital growth.
Yeah.
You're buying a place that's probably not in an area where you're going to be seeing, 10 or 20% returns over a period of time.
Put it this way, Sam Gordon has like dozens of houses and he's still working.
That is true. But anyways, yeah, so keep that in mind. The Aussie dream is passive through property, but when you look at the numbers, as you said, cold hard facts. Let's look at the numbers from a stock market perspective though, because the stock market, just like property, does give a yield.
Yeah, and headline yields, gross yields are similar. The ASX 300, the top 300 Aussie stocks, looked at together, the dividend yield is around 4.5%. The good news for stocks, though, there are none of those costs that we're talking about with property.
That's
so that 4.5% is 4.5% in your pocket.
In the pocket.
Obviously, you do have to pay tax on that, but
Bit of brokerage.
well, no, you don't pay brokerage on dividends.
No, but you've paid the cost base to get the stocks.
Yeah. So you do lose some of that to tax, but yeah, that is why we like it more. Just because the difference between the gross yield and the net yield is far less in investments other than property.
Yeah. Now, there are ETFs specifically designed to maximize the dividends that are paid to you on a yearly basis. To give you some examples, some very popular ones here in Australia, you've got the iShares S&P ASX Dividend Opportunities ETF. For the last financial year, it spat out 5.87%. Another very popular one is the Vanguard Australian Shares High Yield ETF. So it gives you access to Aussie stocks specifically selected for high dividends, for 5.84% for the 12 months. And then there are three others, the Global X S&P 300 High Yield, the Russell High Dividend Australian Shares, and the SPDR MSCI Australian Share High Yield Dividend Yield Fund. Lots of yields in there. The point is that there are ETFs specifically designed to maximize the dividends paid.
And here's the thing. We don't think you should be using them to invest your way to passive income.
That's right, because there's a two-phase process here that you need to go to. The first phase is actually building a portfolio that is of a considerable enough size to actually pay you enough to replace your salary. So that's phase one. Phase two is then making that investment actually spit out dividends.
And we think there are better assets if you isolate each of those phases and attack them individually. These dividend yield maximizing ETFs are kind of trying to give you phase one and phase two together. And that's, you want to attack them one at a time with the right investments at the right time. So we've got a step-by-step guide. Let's go through it. 4 steps to invest your way to passive income. Bryce Lesky, what are we starting with?
Ren, first thing we need to do is actually calculate our target income number. How much do we want to be replacing? And in this instance, we're going to be using the median salary here in Australia, $65,000 a year.
Yeah, and whatever your number is, you follow along and calculate with whatever number makes sense for you. A general rule of thumb in retirement planning is you want to target 70% of your pre-retirement post-tax income.
Nice.
Yeah.
All right, number 2. Once we have done that, we actually then need to figure out what is the size of the portfolio that we need to then spit out enough income to replace my salary.
Yeah, so let's use that $65,000 number. We said that the dividend yield on the ASX 300 was 4.5%. Let's use 5% for just ease of maths.
Yep.
So we take 65,000, our target annual income, we divide it by the expected yield of our portfolio. So in this case, divide it by 0.05, and we get a target portfolio size of 1.3 million.
Sheesh.
So that's our big number up in lights that we're chasing that will then be able to generate the passive income that we want to do whatever we want with our life.
Yeah. Now, number 3, we got to grow to that 1.3 million as fast as possible.
Yeah.
And there's
Well, as fast as sensibly.
no, I think as fast as possible. Now, what we've said before is we don't recommend doing that with these dividend yield maximizer ETFs because they're not designed for maximum growth.
Yeah.
They're designed for maximum income.
And what we mean by that is like, let's take VHY, Vanguard High Yield, which is probably the most popular one. They're selecting the stocks that pay the highest dividends so they can maximize the dividends that are paid. But in doing that, what you do is you prioritize slower growing, more established companies that pay out more of their profit as dividends, and you take out younger companies that are faster growing, that are taking their profits and reinvesting them in the business to grow more. So it's just, you just miss out on that growth by focusing on income.
Yeah. So what we're saying is for that initial stage of trying to grow to 1.3 million or whatever your number is, focus on capital growth ETFs or investment options. You could do it through property if you want, or there are plenty of other assets out there to get to that 1.3 million and then flick it across.
And if you do it with property, it's the same thing. Don't focus on the cash flow deals at the moment. Focus on the capital growth deals so you can grow your portfolio size, and then you can focus on the cash flow later. So whatever your investment choice, it's just focus on this two-step process and take them one at a time.
So what do we need to get to $1.3 million? Well, if we were to invest $100 a week at 13% per year, which is the average ASX return over the last 100 plus years, it's going to take you 27 years to get there. If you double that to $200 a week, it'll take you 21 years.
Yeah.
If you triple it, et cetera, et cetera. If you're in that mindset of getting there, we know that people are investing a lot more than that, but that's just an illustrative example.
Yeah, one tip that Tash from Tash Invest gave us was rather than focusing on replacing your total salary and like having this big number and having to go all out, you can try and replace costs in your life in bite-sized ways. So Tash's example was she worked to replace her rental cost with passive income. She's building her portfolio to the size where then she'll be able to put it in income paying assets and then cover her rent cost with that.
Yeah.
And that makes it a much more manageable proposition.
Yeah.
So I like that way.
Yeah. So like, for example, if we were to replace the team lunch here on a Friday every week, about $200, that's 10 grand a year for Equity Mates. We need a portfolio of 200 grand.
Yeah, okay. That's more achievable than 1.3
Absolutely,
million. Yeah.
Absolutely. So, yeah.
So then once you get that total portfolio size to the size that you want, then it goes to step 4, which is get it in the right income paying assets. And to our point earlier, again, it's probably not these dividend yield maximizing ETFs. Like they're not bad, but like once you've got hundreds of thousands of dollars, or in our case, $1.3 million, the opportunities for other income paying assets are a little bit more interesting with perhaps a little bit less risk.
Yeah.
Now, I get these emails from a mate of ours who works in fixed income. And I just see some bond deals. I can't afford to get into any of them. But you just see...
But if we had 1.3 mil, maybe.
Yeah, well, definitely, yeah. But you just see the yields on some pretty blue chip Aussie companies' bonds are higher than the dividends paid out by these ETFs. So, Coles paying 6.43% on their bonds. Westpac, this one 7.5%. And some of these will move with interest rates. They'll pay like 3 or 4% above interest rates. But it's just a reminder that once you get to that level, once you finish step 3 and you've got your portfolio to that size, there are plenty of opportunities, perhaps outside what we can access now.
Absolutely.
So, Bryce, that's our step-by-step guide to replacing your salary with passive income. Now, I want to just be clear that people who are talking to retirement planners or advisors out there, what we haven't spoken about here is a retirement planning strategy where you draw down your superannuation or your investments. That is a whole other conversation that we could have. Talk about, the 4% rule and drawing down a little bit from your principal every year. What we wanted to talk about here was actually just replacing your income with passive income. And, for people who are thinking about FIRE and trying to retire as early as possible, they're not in that long-term retirement planning drawdown stage. They want to keep their principal preserved because they might want to be retired for half their life.
Yeah.
And so this is the don't draw down your investment account and just get passive income way. But there are plenty of ways to retire early, and this is just one method that we're talking about. Top of your head, if you were going to do this, what's the first cost you'd want to replace?
Golf membership.
Well, you might be investing for a while.
Yeah, good question. I don't know. There's anything that contributes to mortgage is helpful.
Yeah. I'd love if you could replace your mortgage payments with passive income.
Yeah, that would be
Take a while.
That would be pretty handy. Take a while again. Yes, but look, don't be deterred. There are ways. There's certainly. I think we've illustrated how you can do it. Find the number. It doesn't have to be a full replacement of salary, but the beauty of this is that you can at some point get some income from your investment portfolio.
Yes. Well, look, if it's going to take some time, it means we're going to be here for a while making content on Get Started Investing and on Equity Mates Investing podcast. So if you haven't subscribed, make sure you do wherever you're watching or listening. We'd love it if you got involved in the show. You can by leaving us a voice note or writing us a message, but we love voice notes.
Love it.
Head to the link in show notes or equitymates.com/contact. But Bryce, that'll do us for another episode. We'll see everyone next week.